Hello and welcome. The power sector is ripe for disruption, not only from renewables, but there is another angle to power which is also ripe for disruption, and that is being currently captured by IEX. There's plenty of talk around market coupling, market decoupling. What is that and what does it mean for the power sector as a whole? We'll try and understand all of that and more when we have a conversation with PTC India. But first off, let's start off with what I want to know about the company. I'm going to talk firstly about the risks. Of course, we've spoken about market coupling, market decoupling, and what the risks are to PTC India's business. We'll first understand that in the about the company section, but you want to understand this is what I want to know from PTC India. So market coupling, market decoupling, what the risks are. What is the plan to shrink working capital? They have a large working capital quantum locked in their balance sheet. I want to understand what are the plans to kind of unwind that. Plans for utilization of excess cash. They have 3,000 crore plus of excess cash. Of course, now with dividend payments having gone out, that may have come down, but what is the plan? And do they continue to, is the strategy to continue to hold cash or not? Is there a plan to scale HPX, which is the only large competitor of IEX as an exchange for power? But they haven't been able to gain significant market share here. So, can they do that? Varsha, and that will be an interesting point to understand as well. And last off, what is the growth and margin anticipation for the next maybe 2, 3, 4, 5 years with regard to PTC India? But as I said, Varsha Chandani joining me this afternoon to try and break this down. I'm going to start off by understanding and explaining what PTC India does and what the business is all about. PTC India stands for Power Trading Corporation of India. It was incorporated in 1999 under the Ministry of Power Initiative. It is currently owned by PFC, which is Power Finance Corporation, owns around 4%. NTPC owns around 4%. Power Grid owns around 4%, and NHPC owns around 4%. As you would well understand, one is a lender within the power space, which is PFC. Then you have two power generators, NTPC and NHPC. And then you have Power Grid, which is power transmission. And PTC enables this entire value chain or supports this entire value chain. And hence, the owners have also a business performance or their businesses are aided by PTC India, if I can call it that. Now, let's talk about the core business. It's power trading. And they do power trading across short, medium, and long term, right? They have a license, one trading license, which is the highest grade license for power trading. Their clients, let's talk a little bit about that. State discoms, industrial users, power generators, cross-border utilities in Nepal, Bhutan, and Bangladesh, all of those use the services of PTC India. And their group company is PTC India Financial Services, which is 65% owned by PTC India, and HPX, which is actually a power exchange co-promoted by ICICI Group and BSE along with PTC India. So that's all you need to know from a broader lens on PTC India. Now let's talk about exactly what PTC India does, because the largest revenue comes from power trading. And this is where it starts to get very interesting. Let's try and understand this better. They sign contracts with generators for a particular price of acquisition of power. They are particularly power traders. Think of a trader, a pure play trader, right? He's purchasing goods and selling goods exactly in the same way. PTC India purchases power from power generators, NTPC, NHPC, and the like, and thereafter signs contracts to sell this power, and not only sell but deliver this power all the way to the final consumer. So it also takes the onus of transmission, and that's where Power Grid starts to benefit, and therefore Power Grid is also an owner. So you want to understand how this works. They lock buyers on the other side as well. They manage scheduling, payment security, transmission booking, and regulatory compliance. The entire value chain. This is where the business is very different from an IEX. An IEX is an Amazon of sorts. They only link the buyer with the seller. PTC India buys the power separately, sells the power separately. the contract may not be the same tenure, the contract may not be the same price, and the guarantee is taken by PTC India to make the payment and ensure that electricity is transmitted and reaches the final buyer. And that's where IEX is different from PTC. IEX is more of an asset light model. PTC will have large contracts where delivery will have to be ensured by them and will have large receivables because their payments will become due, but their receivables may not be due, and that's where the difference lies. This is how the PPAs are. Short-term 57%, long-term PPAs are 43%. So you can see that the long-term component is smaller than the short-term component. This has also gone up in recent times, even within the market itself, given the price fluctuations we have seen. Now, in terms of where do they supply other than short-term and long-term, and in fact, within short-term and long-term, there is cross-border trade. They supply to Nepal, Bhutan, Bangladesh. I did mention that. And only Government of India authorized entity to do that. And new ventures, co-promoter of HPX, as well as they do energy consulting, green finance. So all of that is also what they do, along with this short-term and long-term trading of power. But the largest revenue stream is the short-term and long-term trading of power. That is where they make the maximum amount of money from. Let's talk about the scale of this. Around 30% or so of the power traded in India is done by PTC India. That's the total number of units traded, 82.75 billion to be absolutely precise. And when you're looking at the average traded price, this is the revenue from the trading of power alone divided by the units that they have supplied. That comes to 3.37 paise per unit. Again, slightly different from an IEX in terms of value as well. Let's talk about vendors. The power generators are clearly vendors. There are state discoms involved. So this is the entire supply chain that we're talking about. Customer and partner universe is all of these. You have vendors thereafter, NTPC, Adani Power, JSW Energy, which all supply the power to PTC India to enable whatever it is that they do with that power thereafter to sell it to their customers. Let's talk about a little bit about the trading margin. We've spoken about the trading margin being 3.37 paise per unit. Look at the consulting fee they've made, around 50 crore odd. So again, very small quantum. Dividend and interest is what they receive from their subsidiaries. And you have exchange revenue share coming from HPX platform.
And so Hersh, I'll take why
yes,
customers use PTC. That's a very important thing. Now, if you see, so they do have large multi-year contracts, and PTC provides price stability, payment assurance. Also, they handle legal, credit, and coordination as well. So, and even the states with the poor payment records, PTC has performance risk. So all the risk towards payment, receivables and everything goes to PTC, unlike what we see in IEX, wherein IEX doesn't have to take all such kind of risk, but PTC does take it. So this is one of the reasons why customers go for PTC. Now, talking about the strategic directions ahead, what lies ahead when it comes to PTC India? So the push into HPX, that is Hindustan Power Exchange, which competes with IEX. This offers market liquidity. Also, green transition is one of the strategic direction ahead, which helps states meet their renewable purchase obligation and design RE power contracts. Also, if you see the cross-border connection, so expanding into export, especially Bangladesh and Nepal is also one of the strategic direction ahead. And lastly, if you see, they're going to diversify earnings via their green infra lending. So diversification, exports, then Hindustan Power Exchange, that is HPX, are some of the strategic directions which is ahead when it comes to PTC India. Now, Hersh, I think it's time to move for the financial analysis when it comes to PTC India. Let's
do that, but let's explain coupling and decoupling just very quickly, Varsha, because that's very important to understand. What is market decoupling? Market decoupling is a situation where pricing in electricity markets are no longer linked to coal prices, demand or supply. Mind you, electricity is a very commoditized business, and therefore prices ought to be linked to some of the commodities like fuel and like fuel costs, which actually run or rather which are the key ingredient in generating power. But markets these days are decoupled, and different parts of the same market therefore operate with separate price formation and potentially different market outcomes rather than being fully integrated and interconnected. So there's no perfect pricing which is there at this point where electricity markets are concerned. Why is this happening? One, you have renewable power, and renewable power is erratic, mind you. Solar power is not available, can't be stored beyond a certain time in the evening. Then you have frequent demand-supply mismatches as a result of this. Buyers are not locked in for years. Buyers are waiting by. They are waiting by for power to come on stream and thereafter buy. Buyers are happy to wait for spot prices to come down. Unpredictable price has started to play out, and you are starting to see state discoms being cash trapped, which is also leading to the uncertainty. Also, one point which isn't coming on your screen is transmission. Transmission has become erratic, and therefore you are starting to see some bit of decoupling as a result of that. Market coupling, on the other hand, affects IEX and HPX. Market coupling is where there is a single exchange which is determining the spot prices as well as the futures prices of power. So market decoupling and market coupling. Varsha, we'll start off with the metrics now. Let's quickly list them down. Income statement, balance sheet, cash flow, return ratios, shareholding, street cred, street coverage, valuations. We'll cover all of these 8. Varsha, start with the income statement.
Sure. Thank you for that. So if you see, income statement in the last 3 years, there's been a degrowth in revenue on a CAGR basis. That is 1%, but the profit CAGR growth, if you see in the last 3 years, have been 4%. Now, why is that? One is the growth in the net profit in the last 3 years that you're seeing is because of the other income that the company has. Say in FY25, the other income for the company was almost 467 crore. So this is one of the reasons that you're seeing a huge spike in in profitability. Say in FY25, if I were to talk about, the sales were around 16,241 crore, and the other income was 467 crore, which led to net profit of 976 crore in FY25 versus Hersh 533 crore. So the boost in the other income because of the sales and investment has led to this profitability, a sharp jump in profitability when it comes to, especially in FY25.
It's an exceptional one-time gain, Varsha, and that's what's impacting that PNL number. Not the right way to look at PNL though, and therefore while we've maintained that net profit number, you want to look out for that 520 crore rupee exceptional item which is lying in the PNL from sale of a subsidiary which they have made. But now let's look at the balance sheet, right? More to be desired here as well. When you're looking at the overall numbers, you're seeing book value. Now this is a 5,300 crore market cap company, mind you. Book value is at 5,800 crore. It has around 2,950 crore of borrowing, not looking like a very solid balance sheet, but you look at the cash bank and suddenly things turn around. You've got 3,300 crore of cash on a 5,300 crore market cap with a borrowing of around 3,000 odd crore. So just kind of highlighting all of those pieces, want to see as to how that cash bank balance is going to get utilized and where the debt number goes. We're going to give this a neutral. Varsha, cash flow.
Yeah, so on the cash flow side, if you see, in FY25, company had almost 2,132 of cash flow from operations versus 2,451 in FY24. But the net cash flow for FY25 standard around 859 crore versus negative 110 crore in FY24. Now, positive cash flow in FY25 that you're seeing is because of the sale of shares, which is nothing but the other income, and that has come into cash. And this is the reason that sharp jump that you're seeing. Because if you see in FY23, there was the operating cash flow was 3,575, which came down to 2,451, and then now you have around 2,000 crores of cash because of the other income or because of the sale of the shares that you're seeing. So overall, Harsh, if again the huge spike in the net cash flow that you're seeing, that from negative 110 crore to 859 crore of net cash flow in FY25 is because of the sale of shares. So overall, we would give a kind of neutral sort of rating when it comes to cash flow.
There's also some unwind on the receivable side, Varsha, which
Yeah.
is what is impacting cash flow as well. So all of those points to look out for. Let's quickly look at how the ROC and ROE ratios are shaping up, and they're all single digit, but late single digit or just about double digit. And when you're looking at that number, it's also pertinent to note that the cash component in the balance sheet is very, very high, and that's probably also what's keeping a lid on ROE and ROC ratios. I'll read them out very quickly. 2,000 crore of cash on the balance sheet in FY22, similar number in FY23, FY24, FY25 at the end is around 3,300 crore. Dividend distributions may well equalize that, but you want to keep that in mind when you are looking at the ROC and ROE ratios. But Varsha, very quickly, shareholding.
Yep. So overall, if you see the promoter shareholding, it's kind of disappointing because you have only 16% of stake which is held by promoter, and then you have FIIs who is holding 26%, though that has also come down from 33% to 26%, and while DII's stake has also come down from 10% to 7%, and of course the public shareholding has gone up from 41 to 48%. So this promoting, you want companies wherein you have a skin in the game. Here you have only 16% of stake in the company, and this is one of the questions that we need to ask. What is the vision when it comes to overall growth for the company? Why the promoter holding is less at 16%, and even FIIs have reduced the stake. So we would give a thumbs down when it comes to holding.
Well, we'll give that a thumbs down. Let's quickly look at Street Cred, what the stock has done. 1 month performance, 3% up, but 6 months, 24% up. So strong returns. Year to date is around 18% returns. 1 year is negative 14. But you look at the 5-year chart, it's nearly a 3.5 plus bagger. And that's what really stands out. We've given this one as the only metric where there is a thumbs up, frankly. But that stock price performance clearly reflecting valuations, Varsha.
Yes, so the current P, if you see Hersh, it is around 9x. But if you just cut down all the the other gain and the exceptional item, I would say, the P stands at around 4x, which is looking on the face. If you see, it's looking quite cheap. But we need to know what is the growth aspirations. Right, maybe Street is not expecting that kind of growth from this company, and that's why this kind of the valuation is at an attractive level.
But you look at the dividend yield, Varsha,
yeah,
4 to 7%.
Yes, exactly.
4 to 7% dividend yield, and that is also because of the sale that they've made this year. Can that sustain? Can that grow? Is really the question. And of course, we'll quiz the management with regard to that. Last off, Street coverage. We just have one analyst covering this one, 17% upside. We've gone with the more cautious stance here. We will stick with neutral with regard to this one. So how do all the parameters stack up? Let's quickly have a look, and it'll give us the final KYC rating as well before we quickly move across, and we have the management waiting by. That's how it stacks up. Not looking extremely pretty, but you have 1 thumbs up in terms of Street Cred, and it gets a 3.5 out of 8 on our KYC ratings. We have Manoj Kumar Jhawar, who is the Chairman and Managing Director at PTC India, joining us. Sir, welcome. Good afternoon. It's great understanding this company better, but explain to us what the impact of a market coupling is on your business at this point, because that seems to really be impacting numbers, right?
No, actually, Harsh, I would not like to say that, because market coupling would basically affect the businesses of the exchanges, power exchanges. So definitely we have one exchange in our portfolio. We have invested around we own 22% of the equity in the Hindustan Power Exchange. So should the market coupling happen, it will greatly benefit Hindustan Power Exchange, not directly benefit PTC. But being an associate company, that will indirectly impact us, and indirectly that will be a very, very positive development. That much I can say.
Apologies, sir. I meant market decoupling, sir. So market decoupling, is that impacting your numbers at this point, and what's the outlook like going forward? How are you kind of hedging that risk?
No, market decoupling exactly, I am not very clear actually what you are implying. But if you are looking at our growth plans, then we can definitely discuss. And I was looking at the program, and one thing which was mentioned by you was regarding heavy cash balances which were kept by our company. So I would just like to clarify the air here that recently we have received that money from our sale of PEL assets to NGC. So because of that, around 1200 crore rupees has accumulated on the balance sheet, and because of that is showing in our March balance sheet. That is number one. But definitely we are looking at the opportunities to invest that money so that future growth of the company can be assured, and we are on the lookout for good investment opportunities. So I think that clarifies the area as to why we are having that much huge cash on our balance sheet. It is not there without any reason. It is just that we received this money very recently, and we are looking out for the investment opportunities. So that
What
takes some.
exactly are you looking to invest in, Mr. Jhawar?
Yeah, there are actually a few areas which are emerging. Number one, because of the renewables integration into the grid, a lot of demand has now come up regarding energy storage assets, and I think that gels well with the power traders, because that is what a power trader is expected to buy when it is cheap, sell when it is costly, and that means you basically need some grid scale storage solutions. So we are exploring the opportunities in the energy storage space. We are also exploring the opportunities in renewable energy space, because going forward, we believe that being a pure play trader is not enough, and basically we need to have some portfolio of assets owned by us also, so that we can be more flexible when we are, tailor making the solutions for the ultimate users. So RE and battery energy storage are two things. Beside that, we are big into the ports. Maybe we will be able to, engage with ports in green hydrogen initiatives, etc. But those things are still under discussion stage. I would not like to comment more than that.
Right, got that view, Mr. Jawar. Hi, this is Varsha this side. A pleasure to have you. Sir, just wanted to have your view on what is the outlook when it comes to your HPX, that is Hindustan Power Exchange. What's the current market share that the company has, and what is the where you want to take this market share, and what is the outlook when it comes to this company?
There are two things, Varsha. Number one, recently, I think you are aware that futures trading has been permitted by the SE to MCX as well as NSE. So now both these platforms are going to launch the energy futures products. So with the energy futures coming into the play, there is going likely to be a great demand for a uniform settlement price by all the future market operators. So currently what we are having, that we are having 3 exchanges where they are generating the price signals. So if they somehow in one way or the other, if because of policy push from the government, a market coupling happens, that will be great news for the HPX. Currently, HPX is having a good share of volumes in the TAM market. It is around 27%, but definitely the collective segments, which is the DAM and the RTM, it is only the leading power exchange, which is IEX, which is having almost all volumes. That is because the very nature of the collective transactions does not permit the buyers or the loan buyers or the sellers to go to any other exchange but to the IEX. So unless that coupling thing happens, I think it will be difficult for any other exchange to crack that code of collective segment.
Very interesting. So you're saying that unless coupling happens, the risk remains that IEX will continue to dominate in terms of market share, at least in the exchange segment of things.
In the exchange, not in the DAM and the collective segments, not the TAM.
Yes, absolutely.
Yeah.
Yeah. So sir, talk to us about where growth will come from. You've spoken about battery and energy storage. You've spoken about new investments. What's the kind of growth pipeline that you're looking for the next maybe 3 years? Where does the number go?
Number one, as and when we have an announcement to make regarding our investments, definitely will be coming to the market. But what I can say, that there are 3-4 things which are emerging, and that they will be very, very helpful going forward. Number one, there is a recent draft guidelines which have been issued by the CERC, which is regarding the virtual power purchase agreements. So we see that as an emerging area wherein there would be immense role for a trader to play. That is number one. Number two, as I told you, the energy storage solutions, they are likely to become a big business because there is a huge demand. If you look at the price profile on the exchanges during the daytime, the prices are as low as two rupees per unit, and during the peak hours it is as high as 10 rupees per unit. So that clearly cries that there should be more storage capacity in the market, and we hope that we will be able to fill that gap to some extent. That is two. Number three, of course, is the derivative market, which has recently been opened up, futures, electricity futures. So that is going to be a great thing for us as a trader. We hope that volumes in that segment would be much higher than what is currently being traded on the exchanges, because the very nature of the futures contract, you do not require huge amount of working capitals as you are required in the real markets, and it allows for the hedgers and the financial players also to become a part of the market. So because of that, we think these 3-4 growth drivers are going to take us in future. And of course, we are very well poised to maintain our lead in our core trading business itself. Out of the entire energy which is trading 270 billion units or so per annum, we are currently having 31% of the market share. We are confident that we'll be able to maintain this market share because of our balance sheet, which is very strong. And number two, we have very deep-rooted industry connect. So we know how this market operates, and we are confident that we will maintain our lead in the trading business itself also. Besides that, we also have a consulting division which adds around 50-60 crore rupees to our revenues every year, and we are looking at growing this segment because there are a lot of consulting opportunities which are emerging, and we hope to do well in that segment also.
Sure. So is there an opportunity to increase margins, if at all I can, or rather margin realizations which you make? Is there a possibility of increasing that? Is there upside possibility? That's point number one. Point number two, is there a way in which you're looking to shrink working capital requirements, or that's just part of the business?
Two things. Number one, margins. So regarding margins, Hersh, you would know that currently, except on the renewable energy, the traders are not allowed in any long-term contracts. So it has to be pure play, medium term and the short term. And because of the lower risk in medium term and short term contracts, the margins of course are low. And since that is the only segment which is growing for the traders, so there is a pressure on the margin, but we have been able to maintain our margin so far because of our healthy mix of long-term and short-term trades. Going forward, to maintain this margin, definitely, as I told you, we will need some RE assets in our own internal portfolio so that we can be able to trade, slice, dice, mix, match, and merge that power with our sources of power and tailor-made the solutions for the buying utilities. So that is where I see that to maintain the margin, we will have to have some portfolio of assets in our own basket, which would be energy storage solution as well as RE solutions.
And anything on working capital, sir? Very quickly.
Working capital requirement, if you see, a lot of cash flow which is currently you are looking at our balance sheet has come because we have been able to manage the outstanding position across the debtors. Our outstandings from the Bangladesh have come down, our outstanding from the state utilities have come down. Now we are much better placed and very comfortably placed as regard our outstandings position is concerned. Sure. And we hope that it will be maintained.
Sure. Point taken. Thank you so much, sir, for coming in and speaking with us. It's an absolute pleasure to speak with you and understand everything that's happening in this space. But all the time we have, unfortunately, on this edition of KYC, from Varsha, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.